Sample company purchased the machinery on January 1st, 2010 for $16,000. The machinery had a useful life of 5 years and a $1,000 residual value. It is now 2012, 2 years later, and Sample's in the process of preparing the financial statement, and Sample realized that it incorrectly used straight-line amortization, but they should have used double declining. So this is clearly an error. They should have used straight line, but instead, they used straight line, but instead they should have used double declining. So what we're asked to determine is what is the impact on net income, assets, liability, and shareholders' equity for 2012 with respect to this error. So this question, as we all know, that under MGAB, either RSB or IFRS, Sample has the ability to use straight line or double declining balance in amortizing the asset. So they have the ability to use either or both of those methods. But in this particular question, it focuses on the impact of the error. What is the impact of the error on income, assets, liabilities? So we're going to assume that using straight line was not reflective of the economic benefit of that asset, and that's why it's an error. So let's take a look at the question. So what we want to do is we want to calculate the amortization expense that they would have taken, that Sample would have taken under straight line. So the current depreciation expense was under the straight line method, and they would have used $16,000, which is the cost, less residual value of 1,000 divided by useful life of 5 years to give us amortization of $3,000 per year. So if I was to draw a chart for 2010, the expense EXP should have been 3,000, or what they took was 3,000, and the cumulative amortization depreciation is 3,000, and net book value is 16 less 3 is 13,000, and this is under straight line method. Now, in 2011, they should have taken 3,000 expense. The cumulative depreciation is 6,000, and the net book value is now 10,000. So, which is 16 minus 6. 2012, they should have taken 3,000 depreciation expense. The cum depreciation should be 6 plus 3 is 9. And the net book value should be 7,000. Now, had they used the double declining balance, so called DDB, we need to calculate the rate. The rate equals 1 over straight line times 2, because it's the word double, right? Okay, so the rate we know is 1 over the straight line, which is 5 years, times 2 equals 40%. That's the depreciation rate. So if I was to calculate the depreciation expense for 2010, it would be take the cost. We don't subtract the residual value in calculating the double declining depreciation expense. We only incorporate the residual value only as the adjustment that we need to make on the last year of depreciation expense to ensure that the net book value actually equals 2,000 at the end of its useful life. So in this case, we're going to take 16,000 times 40%. Now normally we would prorate based on the number of months in the first year of purchase, but in this case, because we bought it on January 1st, there is no proration required. So the first year's depreciation is $6,400. So I'm going to write down the expense here under double declining balance. The expense is $6,400. The cumulative depreciation is $6,400. Net book value is going to be 16,000 minus 6,400 gives us 9,600. For 2011, our depreciation expense should be 16,000 minus 6,400 gives us 9,600 times 40% gives us 3,840. Okay, so this should be 3,840, our depreciation expense. Our accumulative depreciation should be the sum of these two, which is 10,240. The net book value is 5,760. For 2012, our net book value should be 9,600 minus 3,840 gives us 5,760 times 40% is 2,304. That's our amortization expense. So we're going to take 2,304 as our amortization expense in 2012. Our cumulative depreciation, it will be the sum of these two, which is 12,544. And net book value is going to be this minus 16 is 3,456. You'll see that we're amortizing or depreciating the asset much faster under the double declining method. So when we're looking at the effect of net income, and that's essentially what the question asked us. So for 2012, the net income, the effect will be the difference between the amortization expense, right? So we depreciated the asset under the straight line. Our depreciation is actually 3,000. So this is the current. And we should have used double declining balance depreciation expense of 2,304. The difference is 696, and we know that the net income is understated, okay, by 696 because we took out more depreciation, okay, under straight line, and we should have used a double declining. Now, in looking at the assets, liabilities, and shareholders' equity, I always like to use the equation because I want to make sure that we balance, right, the shareholders' equity. So we know that the asset net book value under straight line is 7,000. Okay. Under double declining balance, is 34.56. So we know the difference is 35.44. We know that the asset is overstated. So it's overstated by that much. Why? Because if I look at it, the net book value on our balance sheet shows a $7,000 net book value of that machinery. And it should have been, we should have used double declining balance, and the net book value should have been 34.56. So there's an overstatement of 3,544. We know that the liability has no effect. But what happens to shareholders' equity? We know that shareholders' equity has to be overstated by 35.44. Okay? Now, we know it's composed of two things. We know that the beginning shareholders' equity would have been overstated by the difference in the net book value, right? So we know it's overstated by the difference of the net book value, which is 10,000 minus 5760, which is 4240. So we know it's overstated by 4240 plus the net income, as we saw, is understated by 696. Okay, so we know that was understated by 696. So the balance of these two, so we've got an overstated of 4240 plus an understated of 696 gives us 3544 overstatement, which balances. Now, we know that at the end of its useful life, you'll see that the asset, there'll be no effect on the asset, no effect on shareholders' equity at the end of its 5 years, because in both cases, the net book value of the asset should actually be equal to the residual value at the end of its 5 years. And the shareholders' equity, the balances would correct itself at the end of 5 years. Thank you.